Millionaires will be made in the aftermath of the April 2025 market crash, and the deeper the market falls, the bigger the opportunity becomes, especially if you understand how to be greedy when others are fearful. Right now, stocks across all three major American indexes are still reeling from the recent sell-off, with the S&P 500 down nearly 10% year-to-date, and the Nasdaq Composite suffering even worse, down 11.47% since January. But here's the truth that most investors miss. Market crashes don't destroy wealth. They transfer it from the unprepared to the prepared. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." The secret weapon that legendary investors like Buffett and David Tepper deploy during these moments? Cash. Pure, simple liquidity. During the most frightening economic moments, cash transforms from a drag on returns into the most valuable asset in your arsenal. Today, I'll show you exactly how to use cash like the billionaires do to potentially score massive returns in the aftermath of the 2025 crash, especially with Berkshire now sitting on a record $334 billion war chest. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. Why the April 2025 crash is creating a once-in-a-decade buying opportunity for prepared investors. The historical playbook Buffett, Tepper, and other value legends used during market panics. Which sectors are getting unfairly punished by the tariff tantrum and offer the best long-term value? How much cash allocation is optimal for your portfolio right now? The psychological barriers that prevent most investors from deploying cash effectively, and of course, which specific stocks I'm watching to buy when fear reaches its peak. There's a ton to talk about, so let's dive right into why cash becomes the ultimate weapon during market crashes, like we're seeing in April 2025. The anatomy of the April 2025 crash. To understand why cash is so valuable right now, we need to recognize what makes this market meltdown different from past crashes like 2008. Unlike the financial crisis, which stemmed from fundamental problems in the banking system, the April 2025 crash is primarily policy-driven by escalating tariffs. What began with President Trump's Liberation Day announcement has now erupted into a full-scale trade war. The numbers tell the story. U.S. tariffs on Chinese goods have skyrocketed to 145%, while China just retaliated yesterday by hiking their tariffs on U.S. goods to 125%. This isn't just a dispute. It's economic warfare between the world's two largest economies. The market reaction has been severe. The VIX Volatility Index has surged over 40% in just the past month and is up 118% year-to-date. The tech-heavy Nasdaq has been hit hardest, down 11.47% this year. The key insight: this tariff-driven volatility creates a fundamentally different type of opportunity than structural economic crises. When policy is the problem, policy changes can trigger remarkably swift recoveries, as we've already seen with the market's 9-11% bounce in just the past 5 days. Historical power of cash reserves. History consistently shows that investors with significant cash reserves during market downturns dramatically outperform those who are fully invested. And the current data makes this opportunity crystal clear. Consider Buffett's approach during past crashes. During the 2008 meltdown, with markets down over 50%, Berkshire deployed its $47 billion cash reserve into legendary deals like the $5 billion Goldman Sachs investment with its 10% dividend yield and lucrative warrants. Fast forward to today, Buffett has positioned Berkshire with an unprecedented $334.2 billion in cash, over 7 times his 2008 war chest. This isn't accidental, it's strategic preparation for opportunities he sees on the horizon. The April 2025 crash presents similar opportunity signals, but with a crucial difference: speed. While the S&P is down 9.26% year-to-date, we've seen violent swings in both directions, including a 9.33% recovery just in the past 5 days. The Nasdaq's movements are even more dramatic, down 11.47% this year, but rebounding 11.49% over just the past week. The VIX Fear Index confirms this extreme sentiment, having surged 118.83% year-to-date. What makes this especially compelling? JP Morgan's analysis shows these policy-induced corrections historically deliver better buying opportunities than structural economic problems, with investors who deployed cash strategically generating average 12-month returns exceeding 20%. The data is clear. Cash isn't just defense. It's your strongest offensive weapon in this volatile, tariff-driven market. Cash masters. Buffett versus Munger versus Tepper versus Klarman. The greatest value investors have distinct approaches to cash management during crises, providing us with different models to consider. Warren Buffett's approach to cash represents the patient opportunist strategy. Berkshire Hathaway has now accumulated an astonishing $334.2 billion in cash and equivalents, the largest war chest in the company's history. Buffett views this not as market timing, but as waiting for what he calls fat pitches, opportunities with minimal downside and substantial upside. During the 2008 crisis, Buffett's patience paid off spectacularly. While panicked sellers drove prices down, Buffett stepped in with his famous $5 billion Goldman Sachs investment that included both preferred shares with a 10% dividend and warrants to purchase common stock. This position ultimately generated returns far exceeding the broader market recovery. The fact that Buffett has now amassed over $334 billion, more than triple his 2008 cash reserves, should make every investor take notice. This isn't just dry powder. It's a statement about how Buffett views current market valuations and future opportunities. Charlie Munger took an even more extreme position on patience before his passing, once saying, "The big money is not in the buying and selling, but in the waiting." Munger advocated for extreme selectivity, sometimes holding cash for years while waiting for the perfect opportunity. David Tepper represents a more aggressive crisis investor. The Appaloosa management founder typically raises cash ahead of anticipated volatility, then deploys it rapidly when fear peaks. During the 2008 financial crisis, Tepper made billions purchasing financial stocks and distressed debt when others feared bank nationalization. By March 2009, he was aggressively buying Bank of America at $3 per share, Citigroup under $1, and other financials that would return hundreds of percent in the following years. Seth Klarman of Baupost Group takes yet another approach. His fund has sometimes held 30–50% in cash during expensive markets. Klarman views cash not just as dry powder for crashes, but as protection against forced selling. In his classic book, Margin of Safety, he explains that without cash reserves, investors may be forced to sell their best investments at the worst times due to redemptions or liquidity needs. These different approaches highlight that there's no single right cash strategy, but all these investors recognize that liquidity during crashes provides both protection and opportunity. When and how to deploy cash in today's market. The April 2025 crash presents a classic opportunity to deploy cash reserves, but doing so effectively requires both strategy and discipline. Here's the streamlined framework. First, recognize the signals that indicate prime buying opportunities. 1. Extreme volatility. The VIX is up 118.83% this year, with a 40.1% spike in the past month alone. A classic fear indicator despite the recent 37.37% weekly pullback. 2. Policy uncertainty. Peak. We're at maximum trade tension with China's tariff hike to 125% just yesterday, responding to the U.S. 145% tariffs. Historically, markets tend to bottom when uncertainty reaches its zenith. 3. Rapid sentiment shifts. The market's 9–11% recovery in just 5 days demonstrates how quickly policy-driven sell-offs can reverse, creating brief windows of opportunity. Now, deploy cash systematically. 1. Use tranches. Instead of going all in, deploy cash in 20–25% increments during extreme fear moments, like Tepper did in March 2009. 2. Target quality. First, focus on fundamentally strong companies with global supply chains that are being disproportionately punished by tariff fears but have proven adaptation strategies. 3. Maintain reserve capacity. Even while deploying capital, keep 15–20% in cash for unexpected opportunities or further declines as this trade war evolves. This measured approach lets you capitalize on fear while avoiding the psychological pitfalls that derail most investors during market panics. The dangers of cash addiction. While cash is powerful during market crashes, holding too much for too long creates significant risks. First, you face opportunity costs during recoveries. The market's recent 9–11% rebound in just 5 days demonstrates how quickly sentiment can shift in policy-driven downturns. Missing these rapid recoveries can dramatically reduce long-term returns. Second, inflation risk becomes particularly acute with these new tariffs. With U.S. tariffs on Chinese goods at 145%, import prices will rise, eroding your cash's purchasing power while you wait for perfect entry points. The most dangerous risk is psychological. Temporary cash positions often become permanent. Many investors who moved to cash during previous downturns never re-entered the market, missing entire bull runs while waiting for another crash. Balance is key. Use cash strategically during this tariff-induced volatility, but avoid the common trap of waiting too long to reinvest. Remember, even Warren Buffett, despite his $334 billion cash position, continues to own equities worth hundreds of billions alongside it. If you're finding this analysis of cash strategy valuable during this volatile tariff war market, hit that like button so more investors can discover this approach. Your engagement truly helps grow the channel, and I'd love to know in the comments, what percentage of your portfolio are you currently holding in cash? So there you have it. Why cash truly is king during the April 2025 market crash, and how to deploy it like legendary value investors for potentially outsized returns. The key takeaways. This crash is policy-driven and trade-centered, meaning recovery could come swiftly if tariff tensions ease. The extreme volatility, with the VIX up 118% this year but markets bouncing 9–11% this past week, creates perfect conditions for strategic cash deployment. And Buffett's massive $334 billion cash position speaks volumes about the opportunities he anticipates. While the media focuses on escalating tariffs, now at 145% for U.S. imports from China and 125% in the opposite direction, disciplined investors recognize this volatility as a wealth transfer opportunity from the emotional to the prepared. Thanks for watching to the end even though I gave you everything up front. Until next time, this is Harry Bull Run. My name is Harry, reminding you that the best investment you can make is in you.